Good afternoon, everyone, and thank you for joining us today for our Carrick webinar in partnership with Continental. My name is Jarryd Jacklin. I head up the team here for Carrick in Mauritius, and with me today is a very close partner, colleague, and friend of ours, Manish Sharma, who heads up a team at Continental, who will be taking us through a presentation today on probably one of the most important topics that anyone needs to speak about when it comes to financial planning. To give you a little bit of insight, at Carrick, we have set ourselves up on one mission, and the mission statement is simply to change the face of financial services across Africa. So from a holistic standpoint, we work with multiple asset classes, multiple different solutions internationally, offshore, in different currencies, all to create a tailor-made journey for each of our clients to achieve financial freedom. Now, it's always great talking about different asset classes and building up wealth, but what I always say is you cannot build if you are not here, and you cannot build wealth for your family if you are not here. And that is often a key point that is missed in conversations when talking to clients that they've never had that conversation with their current financial advisors about, is what happens to people that are dependent on them. Not only that, there are a number of different uses for what we're going to go through today, which is a very special and particular type of life cover. And for that, we've partnered with Continental to be able to bring this solution to our clients across the continent. So Manish, thank you for joining again as well. Always a pleasure having you with us and taking time out of your day. So really, I'd like to hand over to you to share this with everyone. Again, thank you to everyone who has joined so far for taking time out of your day and really listening to something that is of vital importance, we believe. So Manish, thank you very much.
Thank you, Jarryd. Thank you very much for organizing this webinar. And good afternoon, everyone. So thank you for waiting for us to start this webinar. So I'm Manish. I'm your speaker today. So I'll give you a little background about myself so you know whom you are listening to. So I'm Manish. I'm based in Mauritius for last 11 years. I'm an Indian national, and I'm in business of providing protection solutions for families, for individuals, for businesses, for legacy, for succession planning for last 25 years. So I do advisory for individuals, for corporates, for family houses, how they can protect their families against unforeseen situations, how they can transfer wealth in a systematic way to their next generation, how they can protect their businesses in case of eventuality, unforeseen eventuality. So that is my expertise. I'm partnered with Continental in providing these solutions. Continental is one of the biggest intermediary based out of Dubai. We are a 29-year-old group in this business, and we are headquartered in Dubai with offices in Dubai, Mauritius, Geneva, Hong Kong, India, and we are a big company with a team strength of 300+ people associated with us. Today, though Jarryd has given a little insight, and even the cover screen says that we are going to talk about the life cover, USD Life cover. So today I will going to openly talk about one main aspect of life which no one likes to talk about, which is death. So which is certain, which is beyond my control, your control, anyone's control. Why? Because we don't know what is our date of death. We don't know when it will going to happen. We cannot time it. It's out of our control. What is in our control is that how I can plan that if that day comes, my family, my business, my children, my future planning should not suffer. See, life security is the least thing which we plan for. Reason being, you can plan for buying a house, you can plan for buying a big car or a small car, plan for your kids' education, plan for everything you can plan when you have a money. While planning those things, we forgot to plan that in case I don't reach home tonight or I don't reach home tomorrow, how those plannings can be taken care of. We don't plan for that because no one can imagine that I can die today or I can die tomorrow. Pardon me if I'm using that word openly, but that's what it is. One thing is the fact of life, which is death, which is not in our control. So today I'm openly talking about that why we should plan for our death in the sense that if that day comes, I have already planned in such a way that my family, my businesses are taken care of. Even if I'm not there tomorrow, they will not going to struggle. And that can be planned when you are alive. You cannot plan that when you are not there. So life insurance is one of the important aspect of the investment part or a wealth planning, that it comes first. And investment can wait. If you're planning to buy a house, buy a land, buy a property, or planning to buy a car, or planning to enhance your business, expand your business, that might can wait. That okay, I can do it tomorrow, later, 5 days later, 10 days later, a year later. But a life insurance cannot wait. Reason being, because you cannot plan it. Once a event has come, you cannot buy. Once there is a medical issue, you cannot buy a life insurance. Once an accident happened, person is no more, you cannot buy a life insurance. So that's why this can be planned only when you are alive, healthy and wealthy. So that's the important aspect of life. And people might say, I have a life insurance. Yes, it is good to have a life insurance. But if I talk about a tool where you can design your own policy for your need and requirement, you can customize your own solution. You can say, okay, I need this much cover. I want to pay these many years. I want to withdraw the money because there is a financial requirement. You can withdraw the money. You can decide, okay, I can't pay this year. I have some further financial requirement. You can even do that. You say this year I have excess money. Can I pay excess? You can even do that. Or at certain stage, you come and realize that now there's no need of life cover because I had liabilities for my family, for my business. Now everything is settled. I am old. Nobody needs the money because there is no liability. I need money. You can even take the money back and use it for yourself. So if I give you that kind of a tool where you can customize it, like we build a house. One way is to buy a property, it's already built house, you go and purchase a house. One way is if you have a dream project that I need this kind of a house, you buy a land, you design your own house. You go to an architect, you construct this size of a room, this kitchen, this artifacts, this interior I want to do. Same thing, you can design your own policy as per your own financial need and requirement. So this is that solution. So I'll move further on that and talk about more. So here, Jarryd and myself is your speaker for today. Then moving further, today's agenda is I'll talk about universal life. So this solution is called universal life or high value life insurance or jumbo insurance. There are multiple names in different countries. It is called in different way. How universal life is different than other life insurance solutions which are available in the market, which is unit link whole of life or term insurance policies, how it is different. Who are the biggest insurers in this business? There are multiple insurers. I'll talk about that also. Then why this product provides a complete protection, we'll discuss in further slides. Then how it can be used against the mortgage and loans you are taking, maybe for your property or for your other business requirements, how it can be a collateral for those requirements, and how it can be used as a legacy and succession planning. That is another important aspect to understand, because maybe you are a first generation businessman, or you are a professional, or you are a second or third generation, and eventually at later stage you will going to transfer your entire wealth or legacy to next generation. Now how can you liquidify that? How can you transfer that wealth in a liquid form to your next generation, despite enjoying your 90% of the wealth which you have already built? How you can use that, we'll talk about that, even with few examples also. Moving forward, high value life insurance, this is, as we said, it is called. Why high value life insurance is needed and how it can benefit you? So as I said, legacy and succession planning. You can preserve your estates by providing liquid funds to your dependent or a spouse. So the one simple thing I want to tell you here, when we talk about legacy and succession planning, as I said, you might be first generation businessman or a second or third generation where you have inherited business from your family and you are growing now, or you could be a professional who has built an entire wealth for yourself. Now, at certain stage when you are in your later years of life, what you will do with that wealth? Maybe you will transfer it to your next generation or your kids or your grandkids. Now, either one way is that you sell that entire asset, use it for yourself, nothing goes to your next generation, or you transfer to your next generation by building everything. Most of the time, most of the people, they keep on building a lot of sets and values for them and transfer to next generation. But if I say whatever is your wealth, you can still enjoy 85 to 90% of that wealth while you are alive, and still 100% will be transferred to your next generation. That means you are enjoying also the wealth which you have built, as well as I'm guaranteeing you that in a liquid form. So let's take an example. One of you have a $10 million worth of net worth. Okay. Now that $10 million net worth could be in form of properties, could be in form of business, could be in form of liquid assets you have, could be in form of maybe jewelries, vintage car, whatever you have built over a period of year. Now, what will happen with that? If you want to use it, either you have to sell it off and make it liquid and use it. But if you do that, nothing goes to your next generation. But if I guarantee you that $10 million will go to your next generation, still of this $10 million net worth, you can use 80% or 85%, depending on your age. You can use that within the time you are alive. That means double the benefit. You can still use the wealth you have built, and you are guaranteeing that your next generation will going to get $10 million worth of net worth in liquid form with this solution. So that's an important aspect to understand. Another way is wealth preservation. Wealth preservation in a sense that you have built wealth over a period. Now, in an unforeseen situation, if you have not planned for your family protection or business protection, what will happen that in case of untimely death, your family or your business has to eat out from that wealth which you have built, because you didn't have any protection solution for that. So that wealth will be eaten out by your family to live their life. If you have planned, your wealth stays as it is, which your family will going to enjoy over a period of time, and their need, which is taken care by this life solution, which you have taken to provide protection to your family and businesses. Another is inheritance tax planning. This is very important for people who own property in the areas like UK, South Africa, or where there is an inheritance tax. So UK has an inheritance tax slab of 40%. So in case something happens to the person who owns a property, the property gets transferred to the kids, 40% tax has to be paid to the government after the initial 350,000 pound or something, which is a allowable limit. So most of the people, they don't plan for that. So now in case of eventual death, kids face a lot of problem to arrange that liquid amount of 40% to pay to government, claim that property. So this plan can help out you to plan your inheritance tax liability. So in case something happens, that tax liability is taken care by insurance solution, and the full property gets transferred to the next generation. Key man protection and business continuity, it goes hand in hand for people who own businesses. So whether you have a proprietorship firm, whether you have a family business where family members are there, or whether you have a big business where you have hired CEO, you are a chairman or board of directors. So basically you take this solution for key people of the company. So in case something happened to the key person, the business faces a challenge of liquidity, business continuity. Maybe a key person has taken a loan liability, or maybe the company has to buy out the share of that deceased person, or maybe have to give a serious package to the deceased family. So that money goes out of the company's working capital or a profit. If you have this solution for the key members of the company, where company pays the premium, which is in the range of 2% to 5%, depending on the age of the person, and in case something happens to that key person, money comes to the company. Company can use that money to settle off the debt. Their company can use that money to buy out the share of the person. Company can use that money to pay the severance package of to the family. And another important aspect, let me tell you, which is very unique for these policies. Let's take an example. You are the key person of the family. Okay, you have taken this solution in your name. Maybe let's take a $5 million cover you have taken in your name. Your company is paying the premium. You are young today, 45, when you have taken a policy. By the time you are 70, your kid has grown up and coming in your shoes and taking over a company. You are stepping down and your child is becoming the CEO or the MD of the company. You can transfer this insurance to your son, like you transfer properties. So your policy gets transferred to your son and he can continue this policy as an insured. So you step down as an insured and you can take your son or your daughter as an insured in the policy. They will continue. The important aspect is that maybe when you took this policy of $5 million, it costed X amount to you. Maybe your son, when he's coming in business, you are transferring that policy within the same premium, he might get maybe 10 million or 15 million because of his age difference. Or you can decide to continue 5 million and you can encash the balance amount for yourself. So there is no other plan worldwide which offers this kind of a benefit where you can transfer the insurance to your next generation. Even for the companies, those who hire CEOs from outside, salaried CEOs, you can take a policy name of a CEO. When CEO resigns and goes to another company, no need to surrender policy. Either you can transfer this policy in the outgoing CEO name and tell them, okay, this is the value of policy, which you are paying them as an exit bonus or something, if there's any dues on company to pay to the employee. Or you can let the person go, another person joins in, you can transfer this insurance in the new CEO or the employee who is coming as a key person for the company. So this is very important aspect of this policy. So another thing is charitable giving. There are many families and businesses, individuals, those who have reached to a certain level that they are not looking to grow their income, but they are looking more towards providing charity to the society. They can take this policy and assign it for a charitable giving. That something happens to them, the money goes for the charitable purpose. So that is another aspect to look for use of these solutions. Then who takes these kind of solutions? High net worth individuals.
Sorry, Manish.
Maybe yes, Jarryd.
Manish, sorry to interrupt. Just a very quick question. You went through a couple of a few examples of key uses of it, of this kind of insurance. Now, with those come a number of different time frames. You know, there's a state wind up, there's transfer of ownership of companies and businesses. Maybe just as an indication, because all of these have different time frames, what is the time frame for the usage of, you know, this kind of life cover by means of payout? As an example, payout or transfer.
So there is no, the policy is active from day one. Now, even after taking a policy 6 months later, if someone decides, no, I want to transfer this insurance to my wife or to my son or to my daughter, you can do that.
And upon death as well? So how long is the payout of the death, as an example?
So the payout is decided. See, okay, maybe you can park this question, Jarryd, because when we'll talk about the product features, how this policy works, maybe I'll cover that point there.
Perfect.
Because it will going to answer all those questions we are asking now.
Perfect.
Is that okay?
Perfect.
Okay. So who takes these solutions? High net worth individuals. It can be individual business owners. It can be professionals, maybe working in companies. So anyone who is qualifying to buy this insurance, eligible to buy this insurance. Then business owners, it can be individual business owners, it can be family businesses, it can be corporate businesses. So anyone can buy this solution who is basically key person in the business, they can be insured. Family with illiquid assets. In last 25 years, I have met so many families and all. They talk about lot of net worth. And yes, I have seen net worth of 200 million, $300 million worth of net worth, 20 million, 50 million, 100 million. But when I sit with them and analyze their net worth, I realize that 90% is illiquid. Illiquid in the form of they own so many properties worldwide. They own fine art collections, jewelries, yacht, racehorses, then vintage cars and everything. But the reality is that if the key person, something happens to the key person, it's not easy to sell off a property, to liquidate it, or sell off jewelry immediately, or racehorses, or yacht, or fine art, because to run your life, you need liquid cash. You cannot run your life by exchanging a fine art with someone and buy something. It's not easy. So when I talk to them, the initial discussion comes that, Manish, we don't need a life solution. We have a lot of net worth itself. But when I explain them that, yes, what you have, we are protecting that only. That you will continue as it is. There is no need Whereas we are providing you a liquidity of maybe another 10 million, 20 million, or $100 million, or a $1 million, depending on the capacity of the person and individual or a family. So we are providing a liquid form where you don't have to contribute millions of rupees. So let's take an example. To buy a $10 million worth of property, you might have to shell out maybe $2 million or $3 million. Okay, so buying a $10 million net worth of a property, you have to pay $10 million as of today. Maybe it can grow 100 million in time. But I'm saying to buy a $10 million worth of liquid form of an asset, which is jumbo insurance, you might have to shell out maybe 2% of that. So tomorrow something happens to you, in the property you paid $10 million, that property comes back to the family in form of $10 million. But here maybe you have paid only $200,000 and $10 million is paid to the family. So this is the difference in liquid assets. So this, when I explain to people, they understand and they opt for this liquid asset. Then people with global property portfolios, lot of people love buying property in different jurisdiction, in UK, US, Canada, Mauritius, India, in Africa. But the reality is that it is not easy to liquidate property. It is difficult to manage the taxes and all. And if something happens to the person who owns the property, it becomes a liability for the family to maintain those properties. So we provide them liquidity in form of this solution where they can take care of the property, or maybe at some stage we advise them to liquidate their property and to transfer a liquid form of net worth to their family. So these kind of people buy these solutions. Going further, the key benefits of this kind of a solution, this is available to 150 country nationals. Wherever you are sitting, we can offer this solution to you while you are in your country. There is no need for you to travel to another country for medical, or travel to another country to signing these documents. No, except the sanctioned countries, yes. So there is a guideline for us which countries we can offer, but in Africa we cover almost all the countries. Like I'll give you example, we have given solutions to the people residing in Nigeria, Kenya, Tanzania, Uganda, then Cameroon, Gabon, Ghana, Botswana. So in Africa, if we talk about this, otherwise UK, then I have clients in Bangladesh, India, UAE, Mauritius, everywhere. So we provide solutions to people residing in these countries without they have to step out from their country to sign the documents or to do the medicals. Why these policies are more important? There are inbuilt cash value guarantees, which you can use it for as a financial support in case you need money. Then sophisticated underwriting, we can provide this cover starting from age 20 up to age 85. We can even cover people at age 85. The cover starts from $1 million. We can even provide up to $200 million worth of covers in these policies. So these kind of structures are there. Then one more thing, important thing is that if people are smoker, and as a smoker, you have to pay a premium price. That means it is costlier by around 30%. But if you're ready to quit smoking, you have an incentive that your premiums can drop down. As a non-smoker, if you quit smoking within a year or 2 years time, you pay as a non-smoker premium. Then flexibility is there. You decide how you want to design your own solution, how much cover you need, how many years you want to contribute, when you want to increase, when you want to decrease. If there is a financial challenge, you can even skip your premiums and you can pay later, but you are still covered. So that's another important aspect of this solution. So going on the features of that, as I said, we can offer this cover from 20 to 80 years, but we can go up to 85 also, case to case basis. We can even offer to kids if parents are covered between 10 to 19 years of age. 1 million is the minimum. We can go up to $200 million worth of cover. Open-ended term means you are guaranteed cover till the time you are alive. So it is 100 and beyond. So actual age, if you are asking, a person at whatever age he or she buys the insurance is covered up to age 121. So one thing is guaranteed, death. When we don't know. This plan says whenever it happens, we will going to pay the cover to the family or the beneficiary, whoever is there in the policy. Nobody will going to live up to age 121. So that's the fact, because I have not seen anyone who has lived up to age 121. I have Googled around, I didn't find anyone. Yes, people have lived 105, 110 also, but not 121. So one thing is guaranteed, this money will going to go to the beneficiary. Then There are minimum credit rate in the policy, minimum guaranteed interest rate in the policy, which I'm going to explain you in the further slides. Funding option, you can pay multiple pay, you can choose, you can pay single premium, you can decide whatever you want to do, you can decide on your own. Then post 10 years, there are no surrender cost in policy. You can withdraw whatever the cash value is there, growth value is there, you can withdraw the money. Then you can even take loan on the policy, which is 90% of the cash value. You can even apply for a loan. Then the cash value keep on growing based on the investment these companies make, which are secured, which I'm going to explain you in further slides. Moving on that, the important thing about this plan is that how the growth comes. When you are talking about cash value, you can withdraw and all, the money gets invested in S&P 500 index fund. Now, why S&P 500 index? Because S&P is one of the secured and safest fund, which is top 500 companies of US. So it is an S&P index. Even if you go and Google around S&P historical returns, you will find very few years where S&P has given negative returns. So what insurance company does, they mirror this investment with S&P 500 index, but they have kept a cap. Why cap? Because it's an insurance solution. They cannot put a risk on the investment side that tomorrow S&P has gone down because there is a war between Russia and Ukraine, or tomorrow there is a war between some other country, or COVID comes or epidemic comes, markets are down. They cannot take that kind of a risk. So what they have done, they have put a lower cap. That means in case of a negative return of S&P in any particular year, the return will be 0%. So you are not participating in negative return. But if S&P performs more than 10.25%, maximum cap is 10.25%. So it goes between 0% to 10.25%. Average what they are paying year on year is now 6.39%, which they contribute year on year. So some years it might be 10.25%, some year might be 8%, some year 0%, some year 6%. Average is 6.39%, which they get credited in the client's policy. Now, this is so that's I said protection from negative market volatility, which I already explained you. That upside is capped at 10.25%. Lower side is capped at the floor rate is capped at 0%. Current rate is 6.39%, and there's a minimum guaranteed value which is 2% in case of surrender. That means tomorrow you want to partially withdraw some money, or you want to fully surrender the policy because of any reason. In that year, if the returns is less than 2%, insurance company has to pay minimum 2% guaranteed value on that policy in that particular year. So there is a negative protection from the market volatility, which is a very important aspect. Now, these are the two major insurers in this business, Manulife and Sun Life. So both are 100 plus years in this business. Manulife is exactly 134 years old, and Sun Life is 153 years old. Both are originated from Canada. Both are Canadian companies. For offshore business, they have an entity in Bermuda, and they serve all these offshore policies from their Bermuda entity. They are regulated by both by Canadian authority as well as Bermuda authority. Plus, their credit rating by S&P, Moody's, Fitch, AM Best is on your screen. They are highly credit rated by all these agencies, which speaks about the financial creditability of these companies. Worldwide, there are total 5 companies which do this kind of business, and we are partnered with 4 of them: Manulife, Sun Life, Pan America, and Transamerica. Now, Pan America and Transamerica, they have entered into the African market very late, whereas Manulife and Sun Life, they have a lot of experience for Africa market and all. And out of Manulife and Sun Life has more countries where they can offer in Africa. Manulife still catching up on that, but our way of dealing business is that we always apply to both these companies. Whoever gives us a better rate for client, we go with them, because products are identical. These are mirror products. Both the companies offer similar products, no difference. Moving on next. So another interesting thing to understand here is that how it works. So account value, basically your cash value, how it grows. You pay premium. There are premium expense charges, there is cost of insurance, which is mortality charges, and then there is growth. So what insurance company does, the moment you pay premium, they put it into account value, get invested, you earn profit, then they deduct cost of insurance out of that. So what happens? Your money grows faster. Otherwise, most of the insurance company, what they do, when client pays the premium, they deduct their charges, less amount goes for the investment and your growth goes slowly. Whereas here, the full amount gets invested, you earn growth rate, and then the cost of charges are deducted, so your money grows very fast. On the next side, another important thing is that, see, as I said during my conversation, that we can offer you this solution wherever you are sitting in your country and all. There is no need to travel and all. How this is done? This is done through the trust arrangement. So there is a free master trust offered by both Manulife and Sun Life, where there is a free trustees provided and all, and you are the insured. So tomorrow something happens, the money goes to the trust and trust transfers to the beneficiary. So for that, you don't have to travel anywhere to sign the documents or anything, because there is a free trust arrangement done by both these insurance companies. Moving next, which are different type of insurances. So this will give you more clearer picture. Maybe you might have a life insurance solution from your local insurance in your country and all. So there are one important life solution which you might have heard about is a term life. Term life is mostly like your car insurance, where if there is an accident, claim is paid. If there's no accident, whatever you have paid has gone. So I call a term insurance as a rental property. So for example, you stays in a rental house, you keep on paying rent to your house owner. Now, tomorrow when you leave that house, will they be going to return that amount which you paid to them? No. Whereas universal life or jumbo insurance is your own property. You keep on paying the money. Tomorrow you need money, you can sell that property and you can take the money. So this is the difference. So term insurance, and there is unit linked life insurance, whole life solution is there, which is linked to the market performance. So coverage for life, in universal life, you are covered till the time you are alive. In whole of life, you are covered mostly 99 years or up to age 100. In term life, depend on how many years you keep on contributing, you're covered until that. Adjustable death benefit, here in universal life, yes, you can adjust. You can increase your cover, decrease your cover. So let's take an example. Today, I'll give you my example. In 2020, I took a policy of $1 million for my family. Now, maybe 5 years down the line, 10 years down the line, my financial status if changes, I realize that $1 million is not enough. I can increase it to 1.5, 2 million, 3 million based on my financial status. I can increase the cover in same policy, or I can decrease it. If I have a higher cover, I can further decrease it up to 1 million. Within the same policy, you can adjust your death benefit. Or for example, you are a businessman. So you have taken a policy today for $2 million. Now you are expanding your business down the line 5 years. You expand your business, you bring investors who are investing $5 million in your business. And they say that, Mr. X, we need security that tomorrow something happens to you. From where we're going to recover our $5 million? We need a security on that. You come back to an insurance company and you can say, for next 3 years, I have a liability of $5 million through investors. I need $5 million additional cover in my policy. Based on your financial outgo, insurance company can add on $5 million in your policy. You can assign that $5 million to your investor. And when you settle off that loan or anything, you can further go back to $2 million, which you can do within the same policy, which none other policy offers, whether it's a whole of life or a term plan or a local plan you have taken in your country. Fixed premium required here? No, it is flexible. You can decide how much you want to contribute. Yes, there's a minimum premium based on the term. You say, I want to contribute in a one installment of 5, 10, 15, 20. You can decide based on that. Premium is flexible. Whereas in whole of life or term life, you cannot, there's no flexibility. Whatever insurance company says, you have to keep on paying that. Then flexibility on premium payment allowed. Flexibility means basically your premium is, let's say, X amount. Today you have excess money, you say, I want to pay extra. You can pay. Today you have less amount, you say, I cannot pay this much. Can I pay half? Next year I'll pay additional. You can even do that. Whereas in other insurance policies, you cannot do that. You have to pay whatever is due on time. Here you have a flexibility. Your premium is due in January. You are paying in March, April. Perfectly okay. You are paying next year additional. Perfectly okay. But initially 3 years, we always advise to pay on time, so your policy becomes self-sustainable. Then there is a cash value growth. Yes, there is a cash value growth based on the investment, which keeps on growing on a longer term. In whole of life also, but based on the market performance. In this one, in jumbo insurance or HVLI, there is no market risk. Whereas in universal life, there is a market risk. Term life, there is no growth at all. You can take loans. Yes, you can take loan in whole of life also. Withdrawals, you can make withdrawals in both the solutions. Cash value transparency in universal life, there is 100% transparency, because insurance company shows every year they will going to send you an annual valuation of your policy, where you can see how the growth has happened, how much you have earned in that particular year. In whole of life policy, there is no transparency because it works in the background of insurance company. They do not show that. In term life, there is nothing. There is no transparency because there is no returns at all. I'll move on the next slide.
Manish, just a quick question there.
Yes, Jarryd.
I think it ties into that slide where you're comparing the different kinds of life cover, okay, as an example.
Yes.
And one question that we often come across when speaking with our clients is, yes, I do have a life cover or a life insurance. It's through my employer, which would usually be a term life or a unit-linked whole of life, okay? But what would you say to someone who says, okay, I do have this life cover, and when I leave my employment, okay, with that company, then maybe I will look at a universal life. What would you say in that circumstance?
So, okay, I get those kind of questions from many clients when I meet them, Jarryd. So my simple thing is that you say, I own a property, I have a house. You take a pride of that. But reality is that that house is not in your name, that is in a company's name. So tomorrow when you leave, that house won't be yours. Okay, that stays with the company. Now, when you leave that company, because we don't know, see, the thing is that if it is your own company, you have a guarantee that you will going to stay with your company for life. But when you are working with someone else, with third party as an employer, you don't know how the scenario will going to change in future. Today, you have a cover, definitely while employed with them, something happens to you, they will going to offer that money to your family. But imagine there is a scenario, you left the company because of any reason, maybe down the line 5 years or 10 years. Now, at that stage, when you're looking to buy an insurance, you have to remember three things there. One thing, if you're healthy and wealthy, that insurance will going to cost you higher. Because the younger you buy, it is cheaper. The older you buy, it is costlier. Okay, so it will going to cost you more when you plan to buy in a later years. Second thing, maybe you won't be able to buy at all the insurance. Reason being, because 10 years back, you were healthy, you were able to buy. Now, 10 years down the line, you have some medical issues, which will going to prevent you to buy an insurance policy. Let's take an example, 10 years down the line, someone got a heart problem, someone got another medical issue, which is critical and all. Insurance company will not going to offer a cover. And third thing is that maybe when you get retired or when you leave that company, you are financially not stable to buy a life insurance, which you were able to buy when you were financially stable. That's why it is always said an insurance can be bought only when you are healthy and wealthy. And another thing is that you cannot plan to buy an insurance. That means it is said always that you cannot plan, okay, I'll take it 2 years down the line, I'll buy 3 years down the line, or let me get excess money, then I will buy. Because when you actually in a need of insurance, nobody will going to offer you. So you can only buy when you don't need it. So there is always a need of insurance, but you can buy when you don't need it, because tomorrow when you are not there in the world, you cannot buy an insurance. You can only buy when you are there or when you are medically fit. So this employer thing is not yours. It belongs to an employer. So tomorrow you leave the job, maybe circumstances changes. You cannot guarantee that you will stay with that company for lifelong. So better buy at early age, better buy now than being sorry for being late.
Makes perfect sense. Thanks,
Okay.
Manish.
So moving next, so these are the two insurance companies which we spoke about. These plans are globally accepted. There is downside fully protected, no rebalancing, no fund selection, no headache at all to you. It's already taken care by insurance company, so you don't have to worry about that at all. I'll move on giving you some example. So this is just an example for an age 45-year-old African resident in African country, non-smoker, $1 million and $2 million worth of cover and 20 pay. 20 pay is just example. 45-year-old person pays for 20 years, means by age 65, he finishes his liability of premium, but still covered till the time alive. No need to contribute any premium, but you are still covered. This is flexible. You can say, I want to pay in 10 years time, 5 years time, one installment, or 30 years time. Premium is adjusted accordingly. So if you see a 45-year-old person for a $1 million cover, for a 20 pay contributes only $15,100 per year for next 20 years. So if you see in 20 years time, a person is contributing total $302,000. So $302,000 in 20 years time, the person is contributing, which is almost $1,100 $1,200 a month. You are contributing to provide a $1 million guarantee to your family or your business. So whether the person has contributed $15,100 or whether person has contributed $302,000, in case something happens, $1 million is guaranteed to be paid to the beneficiary. And another important thing to understand, beneficiary can be multiple beneficiaries. You can decide 10 beneficiaries, 10% each. You can decide 25% to my wife, 30% to this child, 40%, and then you can change it because it is revocable. You can change it. You can even make your family trust as a beneficiary. You can make your family trust as a payer also. You can make your company as a beneficiary or company as a payer. So you can do anything with your policy. So $1 million is guaranteed. Now, another important thing to understand is that in 20 years, you have contributed $302,000. Now, in 20 years' time, the value of policy is $252,000 based on the growth of 6.39% average, which insurance company is giving. So net cost on your pocket in 20 years' time is 252 minus 350 divided by 20 divided by 65. Okay, sorry. Just give me a minute. Let me just calculate it for you. Divided by at a cost of $7 a day, you are providing a guarantee of $1 million in 20 years' time. Now, let's take an example. So just ignore this figure calculation. It is $438,000, not 4 million. So in 30 years' time, if you see, you come and say, Manish or Jarryd, I'm 75 years old. I took this policy to provide security to my family or to my business. Now we are at a stage where there's no liability. Everyone is well settled. My kids have taken over the business. There is no need to of $1 million in case I die, but I need money for myself. I'm 75 years old. I want to enjoy my life. I don't need this policy. You can surrender this policy. You'll get around $438,000 back. You paid 302. Or you say, no, I don't need any money. I want to transfer this $1 million to my next generation. I want to assign this policy or make my grandkids as a beneficiary or add this $1 million in my family trust, which will take care of my children. You can even do that. So that means one day, definitely all of us has to die. So whenever I go, because I have assigned this policy to my family trust and my family trust pays the premium. So whenever something happens to me, my family trust will going to receive $1 million. And there are already instructions given in my family trust how they have to use that money. Same thing, you can do anything with your policy. Now, another important thing about this is this $15,000 you can increase or decrease. So today you say, Manish, can I pay $30,000? Yes, you can pay $30,000. Some years you say, I can pay $20,000. Yes, you can pay $20,000. So what will happen? You will not going to contribute $302,000 or for 20 years. You will end up paying your premiums earlier. Plus, you will pay less because you are paying in advance. Or some years you can come and say, Manish, this year difficult to pay $15,000 because I have another important financial liabilities. Like many people did in COVID, there's no income, but there were liabilities. That time, family expenses, kids' education, rentals, all those were the priority, not the insurance premium. Many people came to us, we cannot contribute. They took premium holiday and they contributed in later years. Still the policy was alive. And if something would have happened during that period, $1 million guaranteed was supposed to be paid. Same thing, people can use it as per their financial requirement. Same thing, if you look for $2 million, the premium is $30,100. This is the cash value growth. And there is the best part is that, as I said, there's a zero floor rate. That means there's no negative participation. There is 10.2% upside. This 79 is the guaranteed coverage age, which means in a anticipated example, if I say, let's take COVID starts today and continues for life, or there is market down crash, negative return throughout the life in S&P. Insurance companies still have to pay 2% guaranteed return. With the 2%, the policy will guaranteed run up to age 79 of the person, which means even if market is turmoil, it doesn't grow, COVID is there, pandemic is there, or war continues, still the policy guaranteed runs up to age 79. It's a hypothetical scenario because that will not going to happen. Some years will be negative, some years will be positive. So it will going to continue. So this is the best part of this solution, which can be used to secure your present, which can be used to secure your future also if you live longer. And another best part is that if you are healthy, medically fit, the chances is that post underwriting your premiums get discount. So based on your medical underwriting, you can get a preferred rate or super preferred rate, and you end up paying less. So that is also one way of looking at. So I'll give you two examples of scenarios. One example, Mr. David. So he has a family and business protection planning he wanted. So he's a 45-year-old non-smoker, lives in East Africa, where he runs his own business. He needs life cover for his family and business protection, which is worrying him because he's the only businessman and only key earner for the family with kids, 2 kids or 3 kids. Tomorrow something happens to him, kids are small, who cannot take care of business, wife is not in part of the business, or wife is working with a small income. So he's the main key person for the family. If something happens to him, family will going to struggle for liquidity as well as business. So he can't afford to take unnecessary risk and stock market fluctuations. So he took a plan to take a $1 million cover in this plan. And then he plans to surrender this policy at age 75 because he will be in a situation where his kids will going to step in into the business, and then he don't need $1 million cover because his liabilities are all sorted out. So he takes this plan, he pays $15,100 a year, and at age 75 he gets $389,000. He contributed only 302. So he has a peace of mind that my family is taken care. So this is one way to look at it. Another example, let me give it to you. So we have John, who is a 50-year-old person, has 2 sons, David and Will, all lives in East Africa. John has an established business which is valued at $2.5 million. Now, his son David is associated with his family business. This might be a reality for some of you who are in this call because I have dealt with a lot of business people with this scenario where they have 2 sons. One wants to be part of the business, one just wants to follow the passion. I don't want to come into the business. But when it comes to transferring the assets, as a father, you have to give equal share to both the kids. Now, here, if you look at the challenge is that the David, the son who is associated with business, it is unfair for him to give 50% of the share to another son who is just pursuing his passion, because he will not going to justify the business. Entire effort is given by David. So in that scenario, when you have to do proper succession planning, so what we advise to these kind of clients is that you have evaluated your business at $2.5 million. Take a policy, liquid asset in your name, which is $2.5 million. Assign that policy to your son as a beneficiary. So in case something happens to the father, one son, David, who is putting effort into the business, he gets full business, which is evaluated at $2.5 million. And another son gets liquid amount in form of liquid cash, $2.5 million. Both are happy. Both are happy because one gets full business, another one gets cash. Now, one way to look at is 2 years down the line, 3 years down the line, 5 years down the line, business might grow. So you can reevaluate your business and then you can add on your policy value. So if your business is evaluated at 3 million, you can increase your cover by another 500,000. You can make it 3 million. Your another son is also happy. So if you see, He takes a life cover of $2.5 million, contributes $53,500, that too for 15 years, which is he's contributing $802,000 only. And in case something happens to him, one son will going to receive business evaluated at $2.5 million, another son gets $2.5 million cash. So both the family is happy. So this is another way of doing a legacy or succession planning for your family. So these are different ways. There are multiple examples where people has benefited with these kind of solutions. One example I'll give you. I have a client which I initially said how you can use your total net worth. I have a client based in Bangladesh. So when I met last him in October, I was sitting with him and we were doing financial planning. So he has a business worth around $10 million, which he has over 30 years. He has grown his business. He's 54-year-old person and still active in business. Two kids, both are part of business now. One is 27 years old and one is 32 years old, not married. And wife is there. Wife is not part of business. So I told him that now he is at a stage where he wants to retire from the business. He wants his kids to continue the business. So I asked him, how many years you took to build this $10 million? He said, it took me 30 plus years to come at this stage. And I said, what you will do with this $10 million, which is in form of property, in form of business, and some part is liquid, which is around 10% of total of that. They said it will going to go to my next generation. So I asked him one simple question. You spent 30 years to build this $10 million worth of net worth. Now you are not enjoying that and you will transfer it to your next generation. He said, that's a reality. So I said, if I tell you, you can still enjoy 85% of this $10 million, which is $8.5 million. And still, I guarantee you that your son will going to get $10 million as an inheritance from you. He said, how? I said, I will provide you a life solution, which is $10 million by just paying $1.5 million lump sum, or you can contribute on an annual installment also based on your financial outgo. In case you are not there, your sons will going to get $10 million as a inheritance from you, that too in liquid form. And this one, you have freedom. You can sell off your shares or you can enjoy whatever money you have built over $10 million. You can enjoy still 85% of that. He understood it. And then he took a policy, not $10 million, looking at his financial capacity and everything, he analyzed, and he took a $6.1 million cover for himself. And he said, I'll going to pay for 15 years. And whenever I have excess money, I'll keep on contributing additional to finish it early. So it's not that he didn't have money. He didn't have net worth. He had $10 million worth of net worth, but he realized that it took 30 years for him to build $10 million, which overnight I can double it. Maybe with some of you is the same example. You might took 20 years, 30 years to reach to a certain net worth level you have built, but I can double it overnight, triple it overnight based on your financial capacity, where you have to just contribute based on your age between 1.5% to 3%. So for example, it's a $10 million cover. Based on your age, maybe you have to contribute just 1.5% of that, which is $150,000 a year. That too, you can decide how many years. So it can go down or higher based on that. So don't wait. This can provide a family security. Yes, Jarryd.
Sorry, that actually answers a question that's just popped up as well. First of all, it really pertains and talks to the flexibility of how these plans can tailor make to each different family circumstance as well. But the one question that came up is about the premium payment term. You know, the question is there a limit, or do you have to keep paying until you die? And I know that you went through that previously, but perhaps to reiterate, just with this example, that it's a set term that is also flexible. So when your premiums are paid up, if it's a 10-year term, 5-year term, right, after that term, you are still covered for the rest of your life. So it's a very, very good point there of you don't pay forever, but you're covered forever, ultimately.
So yes, premium payment, you decide you want to contribute in one installment, 2, 5, 10, 20, or up to age 100. Your choice, it's flexible. And then even you have chosen a 20-year term. So like my policy, I have chosen to pay for 15 years. So I started this policy in 2020. What I do, I keep on paying extra every year. Based on my financial capacity, I had excess money, so I kept on paying. Instead of my premium is $12,000. Some years I contribute 15,000, some years 18,000, some years 12,000. So I will not going to pay for 15 years. I'll end up paying maybe early my liability and less. So you have that flexibility. So it's not that you've chosen 20 years, you have to keep on paying for 20 years. You can say, okay, I have excess money. Can I contribute $50,000 today? Yes. Your premiums will reduce, your term will reduce. Or some years you can even decide, I can't pay this year, I'll pay half, or I'll pay zero, I'll pay next year. You have full control of your policy. Full control. So this is one of the solution. People ask me, what is the difference between this insurance solution, high value life insurance, or other insurance solution? So my simple answer is, this is Rolls-Royce of insurance business. Because like a Rolls-Royce car, you can customize your own car. You can give your instruction to the salesperson of the car that you need this color leather, you need this color on the car, you need this stitches, this design, your name should be written. You can get it customized. They will design one car for you, bring it for you. Same thing. This is insurance, Rolls-Royce insurance policy. You can tell us what you need. We can design it and we can give you as per your requirement. But important thing is that always give priority to insurance, because as I said, one thing you cannot control, that how long you will going to live. One thing you cannot decide, what is the date of death. One thing you cannot decide, that I can buy it 2 years down the line, 3 years down the line when I'm going to get money. No, you cannot decide that. You can only buy today. Reason being, you cannot predict your tomorrow. So when you cannot predict your tomorrow, what is available today, take it today. And seriously, I realized that even being in insurance field for so many years, I had few policies earlier, but not up to that mark. And even I've been lazy. But during COVID, when I was in lockdown, hearing so many newses and everything, the first lockdown was lifted in Mauritius in 2020 July. And while driving, I was talking to my wife and I said, and I realized that if something would have happened to me during COVID, my family would have struggled definitely for financial requirements, because I'm the only earning member for my family. I have a daughter who is now 10 years old. My parents are there in India, dependent on me. So I was thinking, if something would have happened to me, they would have been into a financial trouble. Then I realized, how can I be so lazy that I cannot plan? I'm planning for my future, which is not in my control. That, okay, I'm going to buy a house, I'm going to do this, we will travel this country, we will give this education to my daughter or to my son. But the reality is that if I don't reach home today, how that planning will going to work? Because I have not created a backup for that. Even when we fly, none of the plane will going to fly until they don't have a life jacket, because if they have to land in a water, they need to have a life jacket. We go into the water, we take the lifeguards with us, we take the life jackets with us. When we jump from a plane, skydiving and all, we ensure that we have a parachute with us. We don't jump and then we realize, oh, I was supposed to buy a parachute. So there is a backup planning. So then I realized I don't have a backup plan. So that was the day I told my wife, no. First priority is I will going to take this, then we will going to think about anything in future. So one thing is that don't make it late until it is out of your control. Take it today, whatever, based on your outgoing capacity, take it. Whether this, whether any, but buy an insurance plan which can provide us security. And statistics says you should have minimum 11 times of your annual income cover to be called sufficiently insured for that period. So if you are not having 11 times of your annual income insurance, you have a shortfall. And don't depend on your company provided group insurance solutions, because that is not yours. That is not your property. So that's what is from my side for today. I would like Jarryd to take it further.
Brilliant, Manish. That was actually one of the questions that came up as well that you addressed there, which is how much is enough? It's that ultimate question: how much do I need to take? And the rule of thumb as a starting point of conversation is at 11 times annual income, which can be quite can be quite scary sometimes, you know, when you consider that, and still, is that even enough? You know, so it's all about what.
So it starts. See, as I said, the thumb rule is just a statistics. I'm not saying that if you cannot buy in 11 times, you are not allowed to buy. No, no, no. Start maybe 5 times of your annual income based on your financial outgo. You know how much you can contribute as a premium. What is your financial capacity? You can decide. So a younger person, can't they contribute $10,000 a year? Maybe for 15 years or 20 years. If you can start it now for $1 million. Later you realize that, okay, now I can increase it to 2 million or 1.5 or 3 million or 4 million. You have a full control on your policy. So it doesn't stop you there, but at least start.
Absolutely. Absolutely. And that's the biggest theme that I think we always take away from this particular solution that you've outlined is the flexibility, which is what you don't often find out there. And that flexibility really speaks for volumes to it. There were a couple of other questions, but I think you've covered that very comprehensively.
Before you go on another question, one thing which I should have mentioned earlier also, no, but I'll mention now. The important thing here to look at is that it is in a USD currency. It's a dollarized solution. So you don't have a currency risk. Yes, you might have to pay by converting your local currency into dollar and all, but this plan always remains in dollar terms. So tomorrow the claim comes, it will come into the dollar currency. Tomorrow you are withdrawing the money, it will going to come into dollar. So if you convert into local currency at that stage, you might get currency appreciation if the currency is depreciated further. So you have two benefits here. There's no currency risk. Plus, you might get currency benefit also when you convert back to the local currency in future when there is a claim or a surrender. So need to look at that aspect also. Yes, please, Jarryd.
It's a large factor, of course, that everyone is thinking about now throughout Africa.
Correct.
You know, and thinking about my family back home in South Africa, we've seen it in Mauritius, even with the rupee. You know, it is a risk that we all face. One of the many risks that we all face from a financial point of view. So Manish, I'd like to thank you very much again for going through that. And I know that you went through some very comprehensive examples there, and I know that you have many more examples with different uses, you know, for these kinds of plans over and above that. So what I would like to just say to everyone on the call is thank you again for joining and taking your time out of your day before a long weekend for most people. What we will do, of course, is reach out directly and answer any additional questions that we have not been able to get through to. We've had a large number of people on the call, so we will be reaching out. If it is something that you would like to prioritize, because we have a number of people that we'd like to follow up with, everyone who has joined, please feel free to type in yes in the chat box if you'd like a call more urgently. Okay, and we can try and prioritize that list of people that we will be in contact with. And of course, everyone who has joined on the basis of having a relationship with someone at Carrick. So please also feel free to reach out to myself or your Carrick representative directly, okay, to find out more. And we'll take it. We'll set up a one-to-one consultation, run through it in more detail, run through your circumstances, how it can work for you and be tailor-made to you individually. And then, of course, we have the support of Manish and his team throughout the whole process. So I would just like to highlight that. Thank you, to everyone again for joining and taking your time out. And of course, you as well, Manish, for sharing your experience and your insights with it. Really appreciate
your time. Thank you, Jarryd, and thank you, everyone.
Thank you.
Thank you, everyone, for being on call and listening to us. Thank you. Have a great day, everyone. Thank you very much.
Have a great day and a long weekend for most as well. Enjoy.
Sure. Thank you. Bye.